Our goal is to break the power of the mob in America and nothing short of it. We mean to end their profits, imprison their members, and cripple their organization. Break the power of the mob.
What the heck?
Our goal is to break the power of the mob in America and nothing short of it. We mean to end their profits, imprison their members, and cripple their organization. Break the power of the mob.
Good evening, good evening, good evening. What is the go-ons, everyone? Hold on, my music is bugging here. Good evening, good evening, good evening, everyone. It is your boy Alonzo Hall of ADH Wealth Solutions, aka the Blue Blazer, and I am here today to bring you another episode of Financial Fridays. I do apologize for missing last week. I had something come up. At any rate, I don't want to be too long because I just got a new video game. I'm late to the party of the new Call of Duty, but I do want to hop on there and play. But before I get to that, I do want to go ahead and share with everyone, the big topic. So today, what we're talking about is this thing called accretion and what accretion is. And the reason it's important to talk about accretion is because I am seeing, due to things like Deep Effing Value, which is the guy who on YouTube exposed and did the whole AMC thing and the GameStop thing with the stock market. And I'm seeing a lot of places online and social media, and people are talking about, investing in Bitcoin or investing in this, that, and the third. And there's a real issue. Number one, you're not an accredited investor, which that's fine. They created apps like Robinhood and Stash, etc., so that non-accredited investors could actually go ahead and um, invest, which I don't see anything wrong with that, because it's a beautiful thing to actually have the ability to get into the market. Now, the difficulty, however, is this. People are now following uncredentialed individuals. So then what happens is you get the blind leading the blind. And just because, John invested in ABC Corp and it's making some money for him and he feels good about it, you may have a different risk tolerance. And while it's making some money this month, like we'll use a stock that I know a lot of people were screaming hugely about, which is Tesla, right? And there was a point, oh my God, Tesla is climbing to, $1,700. And, everybody was really happy about it. And don't get me wrong, that's a great thing to be in it and to, invest in it. But, if we look right now, Tesla is up today, down from yesterday at 816. Today it's $817.90. But there was a point it was up to $1,600. Now, what happens is because people are not actually accredited investors or sophisticated investors, I should say, even some accredited investors are not sophisticated. And so you go watching the market every day and you're going to have a heart attack like that. That's why you have licensed individuals like myself, whose job it is to watch the market every day. You're supposed to put your money in there and let it sit. Okay, if you're looking for a short term, anything less than 12 months. If you're looking for a long term, anything more than 12 months. And that's how you look at that's literally what a short or a long is when you're investing. Like I said, I don't want to make this too long, so I am going to get right into what we're talking about, which is again, accretion. And again, the reason that I'm talking about this is I see so many people who are saying that, they're really into this investment. And I've seen some people be like, oh yeah, I put this money in the stock market and, I'm up so-and-so dollars profit. Okay. When you're investing, the only way you have profit or loss. Okay. So all those people who have Tesla right now, who, when it went up to 1,600, they were happy. And now that it's down to 800, they're sad. Don't be. Because you haven't lost anything, nor have you gained anything. The only time you see a profit or a loss when investing is when you sell the stock. So I want to rewind real quick because I want to talk about how there's a saying we have on Wall Street, right? And that saying is this: bulls make money, bears make money, pigs get slaughtered. So the retail investor is generally the pig, while the institutional investor and the hedge funds, etc., well, those are the bears and the bulls. Okay, I'm sure you'll hear people say they're bearish on something. Well, bears still make money because they use a short strategy. Bulls make money. Sometimes they use a short strategy, but they tend to have a long strategy, right? But pigs, they just come and they don't quite know what's going on. So they get slaughtered left and right because they watch the market every day. They get excited. Tesla went to 1,600. Now it's down to 800. And now they're stressed out. Okay. Don't be a pig. You can be a bear. You can be a bull. But don't be a pig. Pigs get slaughtered. So now we're going to look at this thing called accretion and what accretion is. Okay. Accretion is when you are, quote unquote, in the profit or you're up, right? So let's say you put $1 into a stock, right? You go onto your well, before I go there, I want to finish about the Robinhood thing. So a lot of people were highly upset when they stopped your retail investors from further investing into the certain stocks on Robinhood. Well, Robinhood, just like a lot of these other apps, is built like an open-end fund. So there's you can always buy and sell. all the time, right? There's always offerings. The other thing with Robinhood is it's built more like a mutual fund. Now, why is that? Yes, you can buy individual stocks. You can buy corporate stock on there, but you are not selling in the open market. What you are doing is you are buying and selling these shares to and from Robinhood. So what does that mean? Well, people were like, well, they had GameStop and AMC went up from 100 to 300, and then all of a sudden they had to go borrow $1 billion from the government. Well, there's a reason why. The reason why is they understood that pigs were in the game and pigs were going to go for the slaughter. Well, those pigs were like, well, hey, I'm in the profit. I spent 100 and it turned to 300 overnight because of the pump into that stock. So there was an expected dump. But however, even though they had bunches of people putting money into the coffers of Robinhood, that stock went up. So now what happens is they have to have the money to cover when you sell Robinhood the shares back, because you're not selling the shares on the open market. So you're not selling the shares in those true indices. You're just selling them back and forth between Robinhood and yourself. So every transaction that you're doing is not on the stock market. It's actually between you and Robinhood. And that's why they had to take those funds and they paused the retail investor from further investing to actually protect you, the retail investor, so that you don't get burned. And they protected themselves so that they don't go bankrupt, because the retail investor was going to say, wow, I'm up X amount of dollars. If you look at someone like Warren Buffett, he'll explain to you that the average rate of return on an investment is about 10%. And that's over the course of 20 years, which is your average investment strategy. So now let's go ahead and take a look at what accretion is. Okay. So accretion is the gradual and incremental growth of assets and earnings due to business expansion or a company's internal growth, or sometimes a merger or acquisition. So in the financial world, accretion is also the accumulation of additional income that an investor can expect to receive after purchasing, say, a bond at a discount and holding it until maturity. Now, the most well-known applications of financial accretion include zero coupon bonds, which most people don't know what that is, or preferred stock, like cumulative preferred stock, which is when it's like getting first in line even when you're purchasing the stock on the open market. So some takeaways, though, is that accretion does refer to the gradual and incremental growth of assets. You want to also notice that in finance, accretion is the accumulation of additional income that an investor expects to receive after purchasing that stock and holding, or a bond and holding it until maturity. And the accretion rate is also determined by dividing a bond's discount by the number of years in term to its maturity. So to understand accretion, you got to look at corporate finance. And basically, accretion is the creation of value through organic growth or through a transaction. So, for example, that transaction would be accretion in terms of you had some GameStop stock, and then the guy on Reddit puts out the information, and everybody starts buying into GameStop. Well, you bought GameStop for $100, and then everybody else is buying into it, and now your shares of GameStop are no longer worth $100 a share. They're worth $300 and $500 a share. So your stuff accreted. Okay. So that's an easy way to understand accretion. So again, in the securities markets, purchasing things below their face value, or if we're talking about bonds at their par value, is considered buying it at a discount. Okay. Now, again, this is more specifically towards specific bonds. We will talk about earning accretion as well. But bond accretion in finance, like I said, is actually determined by dividing the discount by the number of years in terms. So in the case of zero coupon bonds, interest is acquired not by compounding. Okay, so bonds increase based on the agreed upon interest rate, and it has to be held until the agreed upon term. Like I said, either less than 12 months or longer than 12 months before you can actually cash it out. So let's take a look at earnings accretion, and this would be in accounting. So the earnings per share ratio is defined as earnings available to a common shareholder divided by the average common shares outstanding. Now, accretion refers to an increase in the firm's earnings per share, sometimes due to an acquisition or transaction. Again, take a look at GameStop and AMC. They accreted greatly. So let's give you an example of what accretion would be. Okay, let's assume that a firm generates $2 million in available earnings for common shareholders and that 1 million shares are outstanding. So the EPS ratio would be $2. The company would issue 200 shares to purchase a company that generates $600,000 in earnings for its common shareholders. So the new EPS for those combined companies is computed by dividing its $2.6 million earnings by 1.2 million outstanding shares, or $2.17. Investment professionals refer to the additional earnings as accretion due to the purchase. Another example is purchasing a bond with a value of $1,000 for the discounted price of $750, and understanding that you're holding it for 10 years. Again, I want to talk more about the stocks as opposed to bonds because I know a lot of people really don't buy bonds. But a really quick fact, like I said, actually closer to bonds, is that accretion of a discount is the increase in the value of a discounted instrument as time does pass, and the maturity date comes closer. Okay, now long-term debt instruments like car loans or short-term instruments, when the obligation is expected to be fully repaid within 1 year, are not always the best. However, if a person takes out, like, let's say, a 5-year car loan, the debt becomes a short-term instrument after the 4th year. Remember, I said if you're a short, it's generally 12 months or less, and if you're long, it's generally 12 months or more. So that's really it with accretion. But what I'm going to do now is I want to show you a brief example of accretion. Okay. And the easiest way to show you that example is here with an indexed universal life insurance, because again, that's actually your first investment option. Most people don't think of it as that because they think of it as a death benefit, which it's not. It's actually a great way to invest. So I'm going to do a quote here for Mr. Reginald Graham. So Reggie Graham is 43 years old, and he wants a $100,000 life insurance policy, but he doesn't want it to die with. He wants it so that he can grow his cash. Well, if we put it in an index, which is attached to the S&P 500, remember that index that Tesla was trying to get onto? Everybody was excited. Oh, Tesla's about to join the S&P 500. Well, this is a life policy that literally mirrors the S&P 500. And it's been around for over 120 years, while Tesla is still fairly a new company. And it's been paying dividends for over 120 years, while Tesla is fairly a new company. I'm not diminishing Tesla, but it's been around for a lot longer and been paying dividends consistently, whereas these other instruments have not been. Okay, so let's take a look at how you can accrete through your life policy. And here we go. Boom. And where is it? Right here. And let's take a look at this. So we're doing annually, right? So he's paying for, again, this $100,000 life insurance policy. This 43-year-old guy is paying $139.48, or $140 a month. Now, people will look at that, and all they're thinking is they're buying a death benefit, as opposed to buying features and benefits. Okay? Now, in this, you're looking at it as actually an investment, because that's what it is. So again, he's paying $1,674 a year. If he dies, his family gets $100,000, but that's not what we're looking at it for. So at the end of 10 years, he's paid $16,738, and he's only got $11,894 worth of cash value. However, that's cash that he can actually go and access. So if you want to be completely honest, he did not pay $16,738 for that life insurance. Why? Because $16,738 minus $11,894 is $4,844. So over the course of 10 years, he actually spent $4,844. Now, let's take a look at the next 10 years. So the next 10 years, now he's in his 60s, 63. He's paid $33,475 into this policy. Now, remember, we're talking about accretion or growth, right? Now, again, let's look at his cash value. And this is why it's always better to get a policy while you're younger than while you're older. Because the younger you are, the cheaper it is. And when you're looking at investment, you're looking at two things. You're looking at, you either have a boatload of money so that you can be very aggressive very fast, or you have a boatload of time. You can be very aggressive or conservative, and still you have the time horizon to actually accumulate wealth. So let's take a look at it. 20 years, he's paid a total of $33,475. But wait, here, look at his cash accumulation and cash surrender value. $40,754. So he's paid a total of negative $7,279, meaning that he has been paid $7,279 to have this protection. In the event that he decides to cancel it, he would get $40,754 from the company. If he decides to keep it, then it's just going to continue to grow or accrete. But again, it's not profit until you take it out. Now, let's take a look at another 10 years, 73. I know people in their 70s and 80s. And due to technology and healthier living styles, people are living longer. So let's look at the 30th year. After 30 years, he's paid $50,213 into the policy. Right? So let's see. 50213. And if we'll look here at his cash accumulation, he has accumulated $96,573. So if I do the math, 50,213 minus 96,573 is negative $46,360. Meaning that Mr. Reggie Graham got paid $46,360 for protecting his family's lifestyle. God forbid something happened to him. But should he decide, you know what, I'm in my 70s, my kids are grown, they're in college, they have houses, I want to go travel the world, he can cash out this policy, and basically there's $100,000 for him that he got for just being a responsible adult, and he put half the money away. Let me ask you, when's the last time you've gone to Chase Bank and gotten an interest rate? Because if you go to Chase Bank right now, you're getting 0.0% APR on your regular checking account. And if you have their interest-bearing account, which is their special account, it's an aggressive account, their interest-bearing account starts at a minimum of $15,000 and you get a whopping 0.2%. Again, this is growing at 6.4%. Okay? So that's simple math, and that's the accretion or the increase that you're going to get simply from putting together a simple life insurance policy that's an investment. Remember, I did on the prior Financial Friday, buy term and invest the rest. And that's literally what buying term and investing the rest consists of. What's going on, Perfect Imperfections? He's got some buffering going on here. I see he's interested in that too. Peace and thanks for coming along. So, again, when you're looking at something such as this is an investment. And so you want to look at your life insurance like an investment when it's actually properly put together. The issue is most people go simply determining on, well, why would I pay so much money and then I just die and somebody gets a check? Because that's what it's taught to you as. Okay? So the same thing would apply. Well, if all life insurance is the same, then all Mercedes Benzes are the same. So when I see somebody driving in that S550, their S550 is no different than that C320. But it is. Because the S550 has a whole lot more bells and whistles. See, when you are buying that Mercedes Benz, right, you're not buying just the Benz for the Benz logo, right? You're buying it for whatever specific model it is, right? If I get a CLK, a two-seater drop top, right, that's going to cost me a bit more than if I get a C320 four-door sedan, right? If I get a G-Wagon, that's going to cost, if I get a ML 450, that's going to cost me a lot more than a GLA 250. But there's bigger features and benefits to it. But they are all, just like this is a $100,000 policy, I could show you a different $100,000 policy where he pays a lot less. He also gets a lot less because he's not building this equity. Okay? So what has to happen is you have to sit with your financial professional. You have to give them your information. A lot of times I sit with people and I don't want to give you this information. Look, I can't do anything with your information. And if I could, to be honest, most people aren't in a position where I'm going to want to do anything with your information. Most financial professionals aren't going to want to do anything with your information. Right? Because one person, outside of you being Bill Gates or Elon Musk, I really don't care even if you're a millionaire, because your little $1 million pales in comparison to what I can make off of managing your money. So, you have to look at things a little differently. Anyway, with that being said, I've been running for almost a half hour. I did not expect to go this long. I'm going to try and start keeping these a lot shorter because I like to get directly to the point with you and get it done and through. So everybody who's here watching or on the playback, thank you. Make sure that when you do come in, you smash that like button. You hit the notification bell so that you are informed when we do go live and we give you, all this content. As well, please visit my other social media and hit that Cash App if you feel so inclined to donate. As always, make sure that you love the one. Give the flowers to those you love while they're alive. And this coming weekend is Valentine's Day, so make sure you are very appreciative of those that you love. It doesn't have to be in a mate condition. Maybe there's a friend or a family member who you have love for. Let them know, hey man, I love you, man. I appreciate you being in my life. Those are all good things to do. And with that being said, I'm gonna go ahead and wrap up and get to my game. So I'm going.
In America, and nothing short. Our goal is to break the power of the mob in America, and nothing short of it. We need to end their profits, imprison their members, and cripple their organization. cripple their organization. Imprison their members. Our goal, break the power of the mob.